right, build wealth, live life, economic empowerment, real tips, insight on the new Black Wall Street. It's on the new Black Wall Street. He's your host.
All right, my beautiful people, this is ERGJ, a certified financial educator here with New Black Wall Street. We're going to be talking about taxes tonight. Taxes, what's new for 2017. I got a little bit of information from CharlesSchwab.com. We're going to be talking about taxes, man. It's not what you earn, it's what you keep. And so hopefully this will benefit you as far as just some things you need to know about your federal taxes. I know that we're hitting tax season as well. But not only are you going to be preparing your taxes to file your taxes, but you want to make sure that you have everything set up for this year so you can make sure you're in the right space for 2017. So some things coming up before we get into it as far as what we'll be hosting. Got a couple of sessions coming up, investment sessions. Of course, we teach investment education. We have an investment session tomorrow that'll be covering covering the FANG stocks, Facebook, Amazon, Netflix, and Google. Just to give you an example, Netflix is over 800% in the past 5 years. The question is, has Netflix paid you? We've been watching plenty of it. We're using the Facebook platform, Facebook Live, and also YouTube Live, which is Google. So how are we actually allowing those companies to put money into our pockets? So we're going to be talking about that tomorrow. You want to make sure you get your seat at the table. Changing the conversation at the kitchen table, and this is a virtual table that we have that we can reach people across the country. Secondarily, we have the Sprint just announced a deal that they are buying Jay-Z's title company, 33% of that company. So Thursday, we put up an exclusive investment session so we can talk about Sprint, the impact that that deal will make. Because a lot of people are ready to go and invest in Sprint. So we're going to talk about that on Thursday night. And then next Tuesday, we have our marijuana section, cannabis, weed, 420. So many guys may be interested in investing in marijuana. We want to give you some information before you go and do that so you can be well equipped as you will put your dollars out into the market to try and make those dollars work for you. So we got those 3 investment sessions coming up, and then we got a class coming up first week of February, which will be the Stock Market 101, walk you through the 7 steps to owning your first stock. So if you've never been in the stock market, you're unfamiliar with it, then we're going to actually walk you through how to own your first stock. And then I'm thinking about adding to that, if you sign up for that class, I'm going to do a free class for your children so we can show you how to actually how to actually buy stock for your kids. So I think I'm going to go ahead and throw that in. So anybody who may sign up today, I'll leave that up through Thursday. Anybody signs up through Thursday for Stock Market 101 class, I'm going to go ahead and throw in a class where we teach you how to invest for your kids as well. Open up an account and get your kids started because they can get started as long as they got a Social Security number. But anyway, that's enough of the announcements. We're going to talk about taxes today, what you need to know for 2017. Again, I'm getting some of this information from Charles Schwab. So a lot of different places where you get information, but I want to bring it to you. And our key points tonight is that tax changes in recent years include an additional Medicare surtax for high-income earners, a new top rate for dividends and long-term capital gains, those capital gains tax, and a phase out of items deductions for high earners. If you are subject to higher taxes, it's even more important to take advantage of whatever tax breaks apply to you. So as your income grows and as you hit different tax brackets, it's going to be important that you start learning even more about taxes, or make sure you hire a professional that is knowledgeable about taxes. And then you'll learn more about this year's inflation adjustments and common tax breaks, including retirement plan contributions and charitable giving. So although there are no major tax law changes this year, there are still inflation adjustments and other routine changes to consider. Remember, it's important to take advantage of the tax breaks you are entitled to. So that means no evasion of taxes. It also means no cheating on your taxes, but get the tax breaks that you are entitled to. It's not because you don't want the IRS on your back. I mean, at the end of the day, no one ever wants to get that call from the IRS saying that we're coming to audit you. So just do stuff the right way. It's not what you make, but it's what you keep that counts. So we're going to be talking about a few items that you want to consider for the year ahead. So there's a tax advantage of federal income tax changes. And basically there's a bracket between being in 2017 your income bracket. So for example, if you are single and you make your tax rate for ordinary income, which means just income that you get from like an employer. If you only you don't make more than $9,300.25, you be in a 10% tax rate. You make from $9,000 to $3,700, it being a 15% tax rate. 37,000, 38,000 to 92, about 92,000, 25% tax rate, and then further up from there. If I'm talking any $100,000 owners, 28%, 190 to 400,000, 33%, and 416, 418, 35%. Then anything over 418 is saying 39.6% from a federal tax rate. Now, this may differ from your state tax. We're just talking about federal taxes. Now, here's your tax rate on qualified dividends and long-term capital gains. So once you get into investing, you have, I'm really going to talk about this tonight. Once you get into investing, then your tax rate changes. All right. So remember, I said you're going to at 10% from 0 to 9,300. Well, if you're not making but that much money, then you're actually going to be 0% on your long-term capital gains. Still 0% from 9,000 to 38,000. But once you get to over 38,000, you're in 15% until you get to over 400,000. This is just on the tax rate on your gains. So in other words, what I'm saying is if you put your money out into the market and your money brings back to you less than basically $37,000, then your qualified dividends, long-term capital gains would be at 0%. Now, what is long-term? Typically, that's anything longer than a year. If you have short-term capital gains, then you actually pay the ordinary tax rate on those returns. So that's another thing to consider when you're trying to figure out your investing philosophy, whether you're going to be long-term or short-term. Because again, it's not always what you make, but it's also what you keep. And the shorter the term that you have these dividends or you have capital gains, then the more taxes you're going to pay on that money as well. So again, keep that in mind as you are trying to figure out what your investment strategy is going to be, because taxes play a big part in it. You know, that's how you keep more of your money. All right. So that is the tax advantage there. So payroll and Medicare taxes. So payroll taxes. Now this is something you want to know if you are, you know, a small business owner. You're looking to expand and hire people. Payroll taxes, right? And Medicare taxes. So payroll taxes and Social Security benefits are collected under the authority of Federal Insurance Contributions Act, FICA, not FICO, FICA, and often referred to as the FICA tax. So you probably, if you are an employee, you probably see this FICA tax. For 2017, Social Security, aged old or survivors of disability insurance or OASI withholding remains 6.2%, but the wage-based limit was raised from $118,000 to $127,000. That means that a maximum of $7,886 per employee will be withheld in 2017. The wage base for Medicare withholding remains unlimited, employee tax rate of 1.45%. But the healthcare reform legislation in 2013 increased Medicare payroll withholding from 0.9% to 2.35% for amounts over $200,000 for single filers or $250,000 for married or joint filers. Also, an additional 3.8% surtax applies to net investment income for taxpayers with adjusted gross income over $200,000 or over $250,000. So that Medicare payroll withholding increasing from 0.9% to 2.35%, that's a pretty big jump. And this is net investment income, a surtax of 3.8%, an additional surtax of 3.8% to net investment income for taxpayers with adjusted gross income over $200,000, $250,000. So basically, when you get to that level of income, you have a 3.8% surtax to your net investment income. So basically, as you make more money, typically you have more money invested. And in that money that you have invested, that becomes what they call investment income. And if your adjusted gross income is over $200,000 as a single filer of taxes, you would actually pay a 3.8% surtax. Does that make sense? You guys got that? I know I said a lot in a little breath there, but it's important that you know. I always try to keep my videos as short as possible. Now, this is probably a little bit more important for many of you guys that are here today. I don't know how many people that actually have businesses that they're running and paying payroll taxes. But your long-term capital gains and qualified dividends. So many of us, I'm pretty sure I'm drawn to this video right now, are going to be, some of us are long-term capital gains people. In other words, we invest into the market and we just let it sit there for another, I don't know, another 2 years, 3 years, 5 years, 10 years, whatever. And we just let that money ride. All right, so a top rate of 15%. So think about this, guys. Ordinary income, a top rate of ordinary income is 38%. That's money that you get paid from the job. You pay taxes on. The top rate for long-term capital gains or investment income is 15%. So that's half right there. So once you build up your capital and you're able to put your capital out into the market so that it becomes investable, which means it brings back a return, and then the return is the money that you will pay taxes on, that tax rate is less than half of the top tax rate for your ordinary income. So I just want you guys to capture that right there, because here is one of the biggest reasons why you want to work your way to a point where you get from the left side of the cash flow quadrant, which is you're employed or you're self-employed, to the point where you're on the right side of the cash flow quadrant. And this is from Robert Kiyosaki, where you are a business owner, where you're paying payroll taxes, or you're an investor. Because taxes itself, you get to keep more than half of your money. You see what I'm saying? It's not what you earn. So everybody put in the comments below, it's not what you earn, it's what you keep. It's not what you earn, it's what you keep. So understanding taxes is a big part of that. So again, the top rate of 15%, top rate 15% applies to qualified dividends and on the sale of most appreciated assets held over 1 year. 28% for collectibles. So if you are into collectibles, maybe, I don't know, maybe stamps, maybe some type of cars, maybe some type of wine. You're a collector. You got some collectibles. I don't know who does that. And 25% for depreciation recapture. And that's pretty cool, because that's going to be like things that you've held over time, which have depreciated. I don't know if that's I don't really know what that applies to. Somebody had to tell me. Depreciation recapture, maybe to a house, maybe to a vehicle that was a classic, I'm thinking. I don't know. I have to look that up. Then this is for single filers with taxable income up to $418,400. So a top rate of 15% to qualified dividends and the sale of most appreciated assets held over 1 year. So the time frame is over 1 year. Top rate of 15% for filers with taxable income up to $418,000, and that would be $470 if you were married. Long-term capital gains or qualified dividend income over that threshold, which is the $418,000, are now taxed at a rate of 20%. So basically, if you aren't a person that is making over $418,000 at this point, your adjusted gross income, then your top rate for your investable income, which would be long-term gains and qualified dividends, would be 15%. Do you guys see the difference there? Do you see why the rich keep getting richer? Do you understand why the rich are able to keep more of their money? Because one, they're not making their money off of ordinary income. They're not making their money off of somebody paying them. They're making their money out of putting their money out and letting their money make money for them. And so I think the next book that I'm going to do in my financial book club, I guess I'm going to have to do The Richest Man in Babylon. It's my favorite book, my favorite financial book. I'll go ahead and recommend that to you guys. Richest Man in Babylon by George Clason, written in 1926. And I'm a big believer of wisdom that stands the test of time. So that's going to be the next book we go through. But you'll see why these high earners, they're keeping more of their money. They're paying lower taxes because they're actually making their money from their money instead of making their money from their labor, making their money from their back, making their money from their time. So and this is just law. So once we begin to understand law and how this system works, then we can actually change the way that we think and also the way that we act, and start to shift ourselves from a place of being on the left side of the quadrant. Again, that's going to be where you are employee, and self-employed, over to the right side where you are a business owner and you are an investor. So just a shift. I guess you would call it a paradigm shift. Paradigm shift. So again, it's not what you earn, it's what you keep. So we're talking about taxes. Yeah, that's right, taxes. In my Allen Iverson voice. All right. So phase out items and deductions exemption in 2017. The phase out. I'm sorry, I skipped something. So here's an example of this long-term gains and capital and qualified dividends. If a married couple already has $470,700 of taxable income and an additional $100,000 in long-term capital gains and qualified dividends, in other words, investment income. So they already have taxable income $470,000. That's going to probably be from their business or whatever it is they do to earn money, and they have an additional $100,000 from their investments. The entire $100,000 will be subject to 20% rate. If, however, they only had $400,000 of taxable income and an additional $100,000 of investment income, which is going to be long-term capital gains and qualified dividend. Everybody put in the comments below investment income. Investment income, that's going to be long-term capital gains and qualified dividends. Then they would only have, then $70,700 of the additional amount will be taxed at 15%, while $29,300 will be taxed at 20%. So they're going to take the top off of when they pass the $470,700 threshold. All right, because that is their the limit, $470,700 for a married couple filing jointly. Investment income. Everybody put that in the comments below. All right. So phase out itemized deductions and exemptions for 2017. The phase out of certain itemized deductions and exemptions applies to single payers with adjusted gross income above $261,000 and married taxpayers filing jointly with adjusted gross income above $313,000. There's an alternative minimum tax. The alternative minimum tax income exemption amount increases in 2017 to $84,500 for married and $54,300 for single. You have to just see if you're exempt from the alternative minimum tax. I've never looked into that. Now here's another cool thing. Here's the tax advantage of lower tax rates for children. In 2017, children under 19 will pay no federal income tax for the first $1,050 of unearned income, such as capital gains or interest. So think about that for a second. This is unearned income. This is income that they have. Basically, they're saying if you're under 19 and you have investment income, so they're basically letting you know that you have the ability, that your child has the ability to invest and earn income. And unearned income in this case will be capital gains or interest, right? So they didn't work for this money as far as physical labor. They didn't get paid from an employer. They have their money out working for them, or they have their money invested like in a savings account, money market account, something like that, where they're gaining interest from loaning their money out to a bank or some institution. All right, 2017, children under 19 will pay no federal income tax for the first $1,050 of unearned income and will be taxed at their own rate on the next $1,050. However, they will be taxed at their parents' tax rate on unearned income in excess of $2,100. This will also be the case for full-time college students under 24, unless their earned income is greater than one-half of their parents' support. Individuals under 19 and older and dependent full-time college students age 24 and older pay taxes at their own rate. So if they don't have any unearned income and they just are working and they're under 19, they're over 19 and older, or college students that are 24 and older, they pay their own tax rate, whatever their tax rate is. Now, here's some things for you to consider as far as boosting the retirement savings and potentially enjoying the benefits for some retirement accounts. The 401k, the 403b, the 457, your contribution limit this year is $18,000. So this is the most that you can contribute to these plans: 401k, 403b, 457. Got that? All right. And then, hey, what's going on, Veronica? What's up, Latricia? David Foster, what's up, man? In the business, in his house. If you are 50 or older and you want to try to play catch up, maybe you didn't start investing, you just started learning about this stuff, and you're like, hey, I gotta catch up. You can catch up to $6,000 this year. That means if you're over 50 and you need to play catch up from years past, you can only catch up to $6,000. If you have a simple IRA, it's typically going to be a simple IRA with just a simple IRA with some brokerage firm. Your contribution limit is $12,500, and your catch-up amount for people age 50 or older is $3,000. If you have a key-off plan or a SEP IRA, many of you guys probably don't even know what that is. It's 20% of your net employment income or 25% of compensation up to $54,000. So I'll probably do a video on the key-off plan. Not many people have heard of that, but or a SEP IRA. So I'm gonna start doing more videos about some of these accounts so I can help you guys understand what this stuff is. For an individual 401k, this is going to be somebody that's self-employed and they started a solo 401k that is an option now. 20% of net self-employment income you can contribute, or 25% of the compensation plus $18,000 up to $54,000 will be your contribution limit into an individual 401k. Let me say that again: 20% of your net self-employment income, or 25% of the compensation. If you, in other words, income would be if you got paid as an employer. Compensation would be if you got paid as an employee. As a solo 401k, you can do either or. You can be paying yourself from your business, right? Or you could be getting earnings from your business as income as the owner, or you could be paying yourself through the business as an employee. I hope that makes sense. If you are self-employed or you have a business, hopefully that makes sense. Hopefully you understand that, because you have a business and the business is the entity. Plus $18,000 basically up to $54,000 is your contribution limit. If you want to play catch up as an entrepreneur, as a small business owner, basically meaning that you have a business but you're the only employee. So self-employed. Up to $6,000 is your catch-up if you're over age 50 or older. Now, the traditional IRA and the Roth IRA, your contribution limits this year are $5,500, and your catch-up if you're 50 or older is $1,000. Okay, so these are your limits for your retirement accounts. Now, again, I talk a lot about retirement accounts, and my thing is I want you to understand these accounts, understand how they work. Understand the vehicle for which you're putting your money in. Understand, not only understand that, but understand the what is being offered through this vehicle. In other words, all the different, let's just say all the different gears. You have all these different funds within these accounts that you can select from. Well, you need to understand those accounts. And then also, I would say not only understand that, but you need to understand the economy. The economy has switched as of January 20th. So we are no longer in the Democratic Obama administration economy. We are in the Republican Trump economy. And if you don't understand that, then how in the world do you plan to make effective decisions with the direction for which your money will flow when the river that your money is flowing on is the economy itself? So again, I do offer a retirement review to walk you through all of that, to explain all of that to you, to empower you to be able to take control of your very own money. And if that's something that you're interested in, you can contact me, set up an appointment. We are doing that thing. And if you've been with me before, just know that reallocations, which means that we did this last year for you, and you need to do it again to take a look at current market, at the way the current market is moving. Then it's half price for you because we don't have to go through the whole process of explaining everything to you. We just need to look at what's going on currently with your accounts. So everybody put in the comments below retirement review. Help me out. Retirement review. So a few things to note about contribution limits. The traditional IRA, money you put in a traditional IRA is generally tax deductible. However, if you're an active participant in a qualified workplace retirement plan like a 401k or a 403b, there are restrictions that may apply. If you're a single filer, your contribution is partially deductible if your modified or adjusted gross income is between $62,000 and $72,000. If you're married, couple filing jointly, your 2017 contribution is partially deductible. You know what partially deductible means, right? I hope you do. If you're Magi, which is a modified adjusted gross income, is $99,000, $119,000. If you don't participate in a retirement plan at work, but your spouse does, and you file jointly, your contribution is partially deductible if your Magi is between $186,000 and $196,000. A few things to note about the Roth IRA. If you're a single filer and your Magi is $118,000 or less, your contribution limit is $5,500 or $6,500 if you are 50 or older in 2017. The contribution limit is gradually reduced for those with Magi's between $118,000 and $133,000. If you are a married couple filing jointly and your Magi is $186,000 or less, your contribution limit is $5,500 or $6,500 if you're 50 or older. That contribution limit is gradually reduced for those with Magi's between $186,000 and $196,000. All right. I hope you guys are getting something out of this. Well, how long am I going here? Because I'm trying. 26 minutes. My goodness. All right. Okay. Just this. Here's the last thing, so we can be done with this. All right. So managing college expenses with some nifty tax benefits. So consider these tax favored ways to pay for college costs. 1, a Coverdell Education Savings Account. If you're a single filer, you may make a contribution of $2,000 per year per child, subject to income limitations. Be careful if accounts established by different family members for the same child. Total contribution may not exceed $2,000 in any 1 year. That's important to note because sometimes, like maybe a grandparent or someone wants to contribute to your child, and they got their Social Security number, and they're doing something that you may not know about. So just make sure that no different family members are making contributions. That savings account may not exceed over $2,000 per year per child. Do you have the 529 college savings plan? So the first one was the Coverdell Education Savings Plan. Next one was the 529 college savings plan. Although there's no limit to how much you can contribute each year, each state has their own lifetime limit, typically no more than $200,000 per designated beneficiary. You can also treat a 529 contribution as being made over 5 years of gift tax purposes. The wealthy use gift taxes all the time. They gift their children money. You see what I'm saying? For example, a married couple could contribute up to $140,000 per child up front without using any of their lifetime gift tax credit. So there's this thing called a gift tax credit that we need to learn about as well. And these are when you give gifts, or your children get gifts, and there's some type of credit associated with it. So somebody that's a tax expert, you got to let us know about that. But there's something called a gift tax credit that the wealthy people are using that we need to know about. So tax credits. If anybody know what a gift tax credit is, I'm not acting like I know everything. So go ahead and put that in the comments below. Tax credits. This is another thing that you can use to pay for college costs. The American Opportunity Tax Credit is a modification of the HOPE credit and makes the credit available to a broader range of taxpayers. You may claim up to $2,500 on eligible college expenses paid from a non-529 account, subject to income limitations. So if you don't go with a 529 plan, but you still have to pay for some college costs, and I think many of us know this, right? Because they always ask when we go to the tax office, did you go to school this year? The reason why they're asking you that is to see if there's some college expenses that can be written off as a tax credit. And then you have tax deductions. You may be able to deduct up to $2,500 of student loan interest subject to income limitations. So again, if you went to school this year or go to school this year and you get a loan, well, you may be able to have some tax deductions up to $2,500 depending on your income. And then the last thing is plan your gifts and estate to make the most of these tax breaks. The gift tax annual exclusion amount remains $14,000 for 2017. That means you generally can give up to $14,000 every year to any number of people without those gifts being taxed. Let me say that again. This is what wealthy people do. A gift tax annual exclusion. Let everybody put in the comments below gift tax. A gift tax annual exclusion amount remains $14,000 for 2017. What that means is you generally can give up to $14,000 every year to any number of people without those gifts being taxed. You can also give unlimited amounts towards tuition or medical expenses if you pay the provider directly. Beyond that, the lifetime limit and gift estate tax exemption will apply. And it says basically the exemption is $5.49 million at 40% tax rate. So at any rate, what I wanted to do was just go over some of these tax things with you guys. It's just some stuff that I learned tonight. Hopefully some things you learned tonight as well. Again, we talked a little bit about, the gift tax. We talked about, saving for college costs. We talked about retirement accounts. We talked about long-term capital gains and qualified dividends. We talked about the tax brackets as well. And so hopefully you took a lot away from this. Now, of course, there's some things that we offer here at ERGJ Enterprise that you might be interested in. Again, we got some investment sessions coming up. Tomorrow, we're actually doing our investment session on Facebook, Amazon, Netflix, and Google. Thursday, we're doing our investment session on Sprint with the new Sprint and Tidal deal, the Jay-Z music company. And then next Tuesday, we're doing our investment session on marijuana, or some of you guys call it cannabis. Stephen A. calls it weed, and some of us call it 420 or Mary Jane, whatever it is for you. We're going to be doing our investment session on weed, on cannabis on next Tuesday. And then we also have a stock market 101 class coming up where we're going to teach you how the 7 steps to own your first stock. And my offer to you today is if you sign up for that class by Friday of this week, then what I'm going to do is I'm going to throw in the class that I'm offering to the kids where we're going to teach you also how to buy your kids' first stock. So I'm going to make that special available through Friday. If you sign up for the Stock Market 101 class, we're going to go ahead and get you automatically enrolled in the class where we're going to teach you how to buy your kids' first stock. Because remember, we talked about here today how unearned income for your kids is basically tax-free for the first $1,050 $1,050 that they make in 2017. Again, children under 19 will pay no federal income tax on the first $1,050 of unearned income, which includes capital gains or interest. And when you're investing, you're looking at capital gains tax. All right. Guess tax credit, that's what I'm talking about. So, hey, guys, thanks so much for tuning in. This is ERGJ. I'm almost out of breath, but hopefully you got some good information tonight. Tomorrow, I'm going to be talking a little bit more about this 401k plan and trying to help you guys understand that. But I'm out. You guys have a good night.
Thanks you for joining the show. We gave a lot of great tips, but it's time to go. Take the knowledge we shared, hope you use it and grow. We will see you all there at the next episode of The New Black Wall Street.